Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zach's stock strategist, Jeremy Mullen, who is also the editor of Zach's Counter-Strike newsletter. Now, Jeremy, the reason I have you on this week is because you've been a professional trader for over a decade now, and I thought you'd be the perfect person to have on to discuss all the madness, the craziness happening once again in the stock market, much of it apparently done by new traders. So I thought it'd be fun to have a show where we just discuss maybe some tips you can give to new traders, how people can keep their emotions in check, and what it's like out there trading this type of market. Now, I don't know if you have seen that article in the New York Times about the Robinhood traders, and apparently there's 13 million of them just at Robinhood alone now. And I know a lot of people think that it's all of these new traders that are moving the market and, in certain individual stocks, which we're going to get to a little bit later in the show, and that's contributing to the madness. But where do you see things as they stand right now?
Yeah, Tracy, thanks for having me. It is quite madness out there, isn't it? Just a lot of volatility, a lot of money flowing into the stocks, and a lot of new traders, like you said. But also, there's a lot of institutional money behind this stuff that's making these moves happen. The retail is just kind of fueling the extremes, if you will, both up and down. So I think it's great. I love people getting involved. I am, a decade and a half long trader, so I kind of like seeing the new money in there. I have an edge on them. So, from a selfish standpoint, it's making trading excellent for people of my ilk because we have, the strategies and the know-how and the years of experience to trade around not only the institutional guys and the algos that we've been fighting for years, but this new money as well. So it's been great for guys like me.
Well, that is why I wanted to have you on, because you have been around long enough doing it that it has to be interesting to see the new people in these kinds of trades. Are you seeing anything right now where it's like obvious to you that a lot of new traders are making like the same mistake over and over right now?
Well, yeah. So there are a couple of things. It's hard to tell, who you're trading against, obviously. But when I'm trading a stock like Tesla, I can tell I'm getting pinged by a lot of retail traders because they're trading odd lots. So it's a $1,500 stock. So I'm trading at least 100 shares of that, and if I'm on the offer trying to get out of the up move, let's say, and I'm getting 2 shared and 1 shared and 5 shared, I know who's sending that at me, right? So there's that, but there's also some of the stocks that have wider spreads. When the moves are happening, like a guy like me isn't going to take that wide spread, but if a retail trader is putting in a market order, they're going to take that spread. So there's kind of mistakes like that where they're not using limit orders or using market orders, getting bad fills, or they're doing these odd lot trades in a stock like Tesla or Chipotle or Amazon, and you can kind of sniff out, exactly, you can sniff out those mistakes basically. And that's what these algos do too. The algos are in there capitalizing on the mistakes that retail makes, and guys like Citadel and Jump and Virtu are just loving that kind of stuff because they're making markets in between all this order flow that they're sending them. So it's great for them too.
Yeah. Well, we saw that tremendous trading revenue that some of the banks had.
Yeah, JP Morgan did really well. I saw that.
Yeah. So yeah, definitely some areas are liking what's going on out there.
With the banks, they're not running like the HFTs and the algos like your Citadels, but they're making money off the volatility. Like, so they got guys like me who are more professional than I am, and, you know, doing their things, whether it's fixed income, equity, or whatever instruments they're trading, and they're feasting off the volatility too. Volatility is great for trading. You might have some big down days personally because you took a big hit on a big swing, but what that creates is it creates the next day an opportunity for you to get it back. So I think that just creates this environment where every day there's an opportunity to attack, whether you're a professional or you're retail.
So are you seeing most of the newbie traders in a select group of names? I mean, we keep mentioning like Tesla. Obviously, they're in Tesla.
Yeah, it's the momentum names. I mean, all these momentum names they're flocking to. Usually it's news driven. So if there's an upgrade or good earnings or something like that, they're news driven. They're following the big up moves. Pure example is earlier this week, Netflix had that, or it was last week, excuse me, had an upgrade and it broke out over 500. And the thing went like straight up, like a 45-degree angle kind of throughout the day, 50 points. And that's just this repetitive buying. Nobody's going to step in and get in the way of that. There's good news and they're piling in. Are they selling it all after the 50-point up move? I don't know. But what that's showing you is just this kind of this momentum just is continuing. And you're seeing that across the board in a lot of stocks. I mean, Tesla, on Monday, I don't know if you saw the Robinhood article, but something like, I don't even know what the number was, but it's obscene amount of Robinhood traders added for the first time. And that was at, above 1,600. And it went to, 1,700 and then fell all the way back down in the 14s after that. So it's kind of crazy how the flow is working.
So I saw that you called that move that you just described in Tesla absurd in your recent Counter-Strike newsletter update.
Yeah.
And so what should people be doing about Tesla? Obviously, the traders have kind of just taken over there.
Yeah.
And it's up 61% in the last month.
Yeah. So it broke out from 1,000 and basically topped out yesterday, almost to 1,800. It was like 80% in 2 weeks, right? So that's why I say absurd. I don't really care about I have nothing against Tesla. I don't care about the fundamentals. I root for the company. But to have a move in that kind of name, I think the move was mostly options driven. So there was a break on Friday from 1,500 to 1,650. From 1,400 to 1,550. That was likely driven by market makers on the wrong side of basically selling calls, and it was a scramble in the last hour to cover and get out of that trade. So sometimes the option flow can really actually drive some of these moves when people are on the wrong side of the market. And I know everybody talks about the shorts, and of course they've gotten destroyed, and that's part of it too. But so when you combine like option market makers on the wrong side, shorts trying to cover, and you got this retail flooding in, it makes for this exorbitant move higher. And for a guy like me, I got on the other side of that yesterday, and it paid off nicely. And I continue to they have earnings next week, so I'm continuing to look for some downside. Just a little pullback. That's all I'm looking for.
Interesting. So what kind of advice would you give to someone who, is one of those 13 million on Robinhood, or maybe who just signed up in the last couple months? Is there any advice, or is it just learn by doing? You're going to make mistakes. You're going to have some winners, but you're going to have some losers. What is your advice to new traders right now?
Yeah, you're going to make some mistakes. You're going to lose money, but capital preservation is key, and that stems from discipline. You have to have some discipline. You can't be buying Tesla after an 80% move and expect to double your money. It's just it's a poor man's game. It's just not going to work. And so within that, that's got to be the new guy's focus: is don't do the YOLO trades that I see a lot of these Robinhood traders talking about. You have to stick to a game plan. One of the things I look for on a daily basis is ranges within a stock, so the high and lows of a stock. So Tesla today, the low is 1431, the high is 1590. That's, you know, 160 point range. It's one of the largest ranges out there of any stock. It moves. So as a trader, you can make money within that range. So look for stocks with high ranges and watch these stocks, learn how they move, learn how they trade, dabble in small size, see if you can make money in small size. Once you do, start increasing your size to make a little bit more money, but don't get too crazy. This isn't a get rich quick scheme. This is a grind game. And once you get to a point where you can put on size, then you can start making good money. Within that, like looking for stocks, trying to find stocks, you really want to have some kind of volume so you can trade in and out and not pay big spreads. And what I would say is get a couple go-to stocks. So for me, Tesla is a go-to stock. Amazon is a go-to stock. Roku is a go-to stock. I have the experience to watch like 5 to 10 of those. For new guys, maybe they should only focus on 1 to 3 and just try to master those before they start playing other stocks on a day trading basis, right? Investing in 10 different, 20 different, that's fine. But when you're trying to day trade these and learn how they work, learn how they move, it's really important to just focus on your go-to stocks and go from there. So use ranges, find stocks that have big ranges, and then pick some go-to stocks, watch them, and then just give it a try.
So I understand why Tesla is a go-to, but are Amazon and Roku go-tos as well because of those types of ranges as well?
Yeah. Okay. So they're always moving. They're always big ranges, and they, over time, I've learned how they move. I learned how they trade. They're very reactionary off certain technical levels, so I can look for those levels on a daily basis and kind of, if they seem to be working, trade off those levels. And that's something else. Like within a particular strategy, you can use a variety of different technical levels. I use fibs, I use pivot points, I use VWAP, and I can get into those if you want me to. But those kind of are my map and my guide throughout the day of when I want to be entering the stock, not just blindly, buying it.
Right. Well, that's some of the tips, I feel like the newbies need, because I do think they're blindly just buying off of, as you mentioned earlier, like the headline news or things like that.
Right. So I'll go over those 3 then. Fibonacci retracements are pretty big. You can use these in macro moves. So what I mean by that, over a period of months or years. They can also work in intraday. So what I do is I'll draw the bottom of a move to the top of a move, and it'll give me like a 61.8% level to 50% retracement. Then I'm kind of looking for to see if there's some buying in that area. And what I'll do is I'll buy that fib, and I'll look for a move back to highs or above the recent highs to sell into. So that's kind of fibs. There's many different ways to play with fibs. I have my own particular niche and way I do. A lot of people use different strategies. It's kind of just drawing them and figuring out how they work and then utilizing them the way you want to use them. Pivot points are great. You can just slap those on your charts, and they're calculated new every day. A lot of algos will buy and sell at these pivot points. There's neutral, resistance level 1, 2, and 3, and support level 1, 2, and 3 that I always have on my charts, and that's basically taking the average of the previous day ranges, and that'll calculate on the new day. So it's kind of nice to just have that kind of guide. And VWAP is volume weighted average price. So that's the average price that people have paid during that day. So basically, if price is below the VWAP, the average price is losing money. So they're more likely to be selling into the end of the day. If it's above, people are making money, so they're more willing to add and push that price higher. So I've noticed over time that VWAP is a very important place during the day that you can get like bounces off of. So let's say a stock like Tesla bounced to 100 points, it pulls off the open, it pulls back into the VWAP. That'd be a place I'd be looking to possibly buy if it holds up. So I love those 3 technical. I use those all the time.
Okay, that doesn't sound too bad.
Yeah, you just have to, those are my 3 that I favorite. People use all kinds of different technical aspects. So It's just kind of going through and finding what works for you.
Now, you said earlier that they should be dabbling in small size. What does that mean? What is small size?
Oh, small size just means don't put your whole account into one trade. Maybe do 5 or 10%. So small size, like I was saying, how I'm getting 5 share and 10 share in Tesla. That's probably the right thing you want to be doing, as long as that's not your whole account, right?
Right.
So smaller size, smaller percentage of your account with each trade. I know a lot of people are doing options. That's a good way to take advantage of that. Like instead of putting up, $1,500 for Tesla, you can buy one call for maybe $5 for the 1,600 strike or something. And if it goes up 50 points, you make some money. Just remember, with those options, most of them go to zero. So you're losing probably most of your investment. And I would recommend just using stops on all this stuff. Just capital preservation is key.
Now, you have mentioned a lot of what I would consider like high price stocks. Obviously, Tesla, Amazon's over $3,000. And I see a lot of people attempting to trade the stocks that are under $5 for the reasons of, in their mind, oh, if it's only $1, it doesn't take that much to get to $2, and then I double my money. But
Right.
Is that area a place that new traders should be looking to be in? Like, there's a lot of retail stocks that are trading under $5 right now.
Yeah. So that is an area that a lot of people like to dabble in. It's not my forte. I try to avoid stocks basically under $10 is my kind of general rule. But there's a lot of opportunity there if you can find.
Why do you avoid those?
Because it's easier to make money in the bigger ranges. So so for me, I'm not looking at a percentage move. I'm looking for a big point move. That's how I make my money. So a $9 stock going to $10 isn't as lucrative or fun as a $900 stock going to $1,000, just because there's so much volatility within that 100 points that I can make money. I can get in and out a lot more. So now but for lately, for stocks that are under $5, you're seeing all these like COVID plays. You're seeing all these different plays, and I'm seeing stocks go from like $5 to $25, $5 to $10, $5 to $15, and it's just based on this momentum stuff. And I see it on my filters every day because I have filters and I can see them running, and I have no idea what these things are doing. I have to look it up, and I think a lot of it is somewhat manipulation, because a lot of these stocks are low float stocks, which means there's not a lot of shares in there. So if they have some good news and there's all this money trying to get into the company, that the stocks just go. So like a perfect example is this WIMI was a $4 stock on Friday. It went up to 30 on Monday morning, and now it's down at 17. So stuff like that is just it's happening a lot.
What are they?
WIMI was the ticker.
Yeah, but what are they?
It's a hologram cloud company. Yeah, I'm not even familiar with like what they even do. I just saw it running and I just kind of shake my head. It's not my thing, but for a lot of people, that's what they like to do.
Okay. Is it different to do the stocks that are $1 or under $1 versus any of these? This one was $4 and went to 30. Is it the same game, even if it's just $1?
Yeah, the price point doesn't really matter. I mean, you remember like Hertz was like $1 and it ran to 5 on the bankruptcy. I mean, that's kind of the same kind of banana stuff. It makes little sense. But hey, if you're gonna sit and watch for those, there is opportunity there. I'm not gonna say there's not. But if you want to have like that's not going to happen in all markets, right? It's happening in this market. But if you want a sustainable trading career, you stick with those high range stocks, and that's what's going to pay over the long run.
Are there any other that you consider to be absurd as you were describing Tesla right now? I mean, I took a look at a couple of the names that I know have been running. Wait a minute, where did I find those now? Like Shopify, that one is up 136% year to date.
Yeah, Shopify is definitely bubblicious right now. That thing, it has pulled back, but when you're talking about going from 300 to 1100 over the course since the March lows, that's a great move, and it's a great company. But it's just you really have to be careful buying it up here, because one swoop of bad news and the thing can be all the way back down, right? So I just caution new people. Just I'll keep on saying it. Just make sure you have your stops in. Another one. Let's see. What have we've seen a run in Netflix, but that has been kind of more a slow and steady run. It hasn't been this accelerated move higher. One of the ones that I keep on seeing is COUP software.
Okay.
That went for $300 lately. Was a $100 stock in March, so that thing's tripled. Once again, a great company.
What's the
COUP.
Okay.
I think you mentioned Meli, MELY, which is Mercado Libre. That's another one with an amazing run. Yeah. So here's a good example. That topped up over 1100 and it pulled back almost 200 points real quick. So yeah, you just gotta be careful buying those at the extreme highs.
Yeah, that's the Amazon of Central and
South America. Right. Yeah, exactly.
Okay, what about like Etsy? That's had a big run. But it's come down off the highs. What does some of these have started to pull back? Does that tell you anything? Should I, as a new trader, is that relevant to me right now?
Yeah. So when these pull back, some good areas to look at are these moving averages. So I look at the 200, the 50-day, and the 21. The 21 is kind of like a momentum moving average. So Etsy has just pulled back. It was at 115, pulled back to 100, and it's hanging around this 21-day moving average. So for me, as long as it can kind of hold in this area, the next move higher is probably another buy to highs, because it means it still has that momentum. And with that, like drawing fibs, I'm on the chart right now. What I would do is I'll draw from the June lows. June lows to the recent highs, and what that gives me is a 61.8% retracement around 90, which happens to be the 50-day moving average. So if I'm being patient, I'm looking at that $90 level for potential buy spot for Etsy, and that's kind of how you use these technical levels to sniff out certain areas you want to enter a stock instead of buying it at all-time highs. Spotify was another good one that recently had a nice run.
Oh yeah, they have.
So that went from that was stuck in the mid 150s, and then they had this news with they got Joe Rogan, and then they got Kardashians to do a podcast. So then the stock took off, and it went from about the 160 area to 285 in just over a month, and just a fantastic move. And that's pulled back to the 21-day moving average and bounced a little bit off that. So yeah, we could go through a bunch of these all day.
Yeah,
every day I see them.
So what does that tell you? That it seems like there's a lot more good trading opportunities right now.
Oh yeah, both up and down. I think what the Fed has created a liquidity flood of money, basically, and this money is flowing into stocks, and we're seeing a result of that. I don't know if there's just nowhere else to put it at the moment, but the Fed has the markets back. It seems like they're not going to let companies go bankrupt, and that's a whole nother podcast, but it's creating all this liquidity, and those who have access to that liquidity are putting it to work. And we keep on bringing up retail, the combination of retail and the combination of just opening up kind of economies. It has this good atmosphere. So we'll have to see if this remains. I'm skeptical that it can, but I love it. I hope it stays around.
Yeah, I know you've complained in the past when there hasn't been volatility that, it's really hard to trade when you have those kind of markets.
Yeah. So we went through some real bad markets. 2014, 15 was pretty bad. I mean, the VIX was at 13, 14 for a long period of time with even some moves down in the 11 area. And now we see it holding at 30 ever since February. So that creates this just really volatile trading atmosphere.
Yeah. So on the subject of like a pullback or corrections or, some of these stocks off the high, I feel like for traders, as you were just mentioning, like these are opportunities. It's not necessarily a bad thing for the market to take a break.
Oh, I think it's very healthy. I like a pullback like we had the last couple of days. Well, yesterday was kind of like a reversal. We were up and then went down 2% in the NASDAQ, and the S&P followed. And today we kind of followed through lower, but rallying at the moment. So it's just like, it's just healthy. You don't want to get people too long in the market and have it go straight up, because what happens is it'll go straight down. And what I'm kind of worried with the NASDAQ at the moment is that can happen with some negative news. We have earnings coming up. So let's say earnings don't impress like everybody thinks. Let's say California's momentum with COVID gets worse. Let's say, hopefully not, but Chicago sees a spike back up. There's just, if bad news starts to hit, the NASDAQ is so inflated that we could see this liquidation event down, where it just happens in a couple of days. So I like the healthy markets. I don't want them to go straight up. I want them to meander back and forth and then break out or break down. I just think those are healthier markets. And I think that's kind of what we've been seeing over the last actually over the last month, with the S&P kind of trading between 3,200 and 3,000. Is we kind of consolidating here and deciding, okay, what's COVID going to do to us next? Do we want to break out and ride the back of the Fed, or do we want to break down and be scared of the virus? So it's an interesting place we're at right now.
You just mentioned the earnings season, and we didn't really talk about that. Do you like to trade earnings season? Do you just like move to the sidelines? Should new traders be trading earnings season? Because that seems pretty difficult.
Yeah, earnings is my bread and butter. That's something that I really do well in. I like trading after hours and pre-market on the earnings announcements. You have very, very thin markets. You have just big moves. Fewer, I would say, fewer algos to get in the way of the moves. So it makes it a little more interesting sometimes. Very dangerous. So I would say new traders, no.
Okay.
What you want to do is watch them. Just watch them, see how it moves, see if they are for you. Generally, newer traders, I would say they'd have to get used to how these earnings moves work. So it can be very confusing to see a company beat on EPS and the stock go down. That confuses a lot of new guys. And I just remember when I used to train guys about how long ago was that? 10 years ago. And that was one of the things that a lot of the new people just did not understand, is like they beat earnings. Why is it going down? Well, it doesn't matter. It's going down, so short it. Or vice versa. They missed earnings. It's going up. It doesn't matter. It's going up. Buy it. The people who are buying and selling this stock and have more buying power know more than you. And there might be a little thing in that earnings report that you don't know about outside that headline number that could ruin your day. So don't get in the way of it. Don't be stubborn because you think they beat or missed. Just go with the flow on earnings. That's my number one rule.
Okay. Yeah, you see a lot of people on stock twits that get real frustrated when there's a miss and the stock goes up. and you can tell when they don't get it, and it makes them angry.
Yeah. Well, that could be a bunch of different reasons. Like the miss wasn't like, so there's whisper numbers, like, if it beat the whisper number, then it's actually better than the headline number. But there also could be guidance or something said on the call, maybe a shift of strategy that the market liked. There's all kinds of stuff behind those earnings. And listening to a couple of conference calls and seeing how the stocks react to them is also a good thing to get a feel for those earnings moves. I went through a period where I was just listening to a lot of calls, and I kind of learned a lot about what was said on a call that would make a stock move up and down. And of course, guidance is a huge mover on conference calls.
Okay. So is the number one advice that you would have for the new traders really capital preservation?
Yeah. Live to fight another day. Don't be a hero. The other problem, and I remember this from my trainees, is everybody thinks they're smarter than they really are when it comes to the market. You might be a genius, and it doesn't mean you're going to be smart at this game. I know some really dumb people who've made a lot of money. It doesn't matter how smart you are. The market doesn't care how smart you are. It doesn't care that you think a company should go up because they beat on earnings. It'll eat you alive. So your only weapon that you have to survive is discipline and capital preservation. And that's key. That's the only thing that matters when you start out in this game. Because if you don't live by that, you're going to blow up your account and you'll be done. So it's pretty simple.
Yep, when you put it that way.
And I've blown up, I know firsthand, so take it from me.
Yeah. Now, I'm sure every trader has to blow up at some point, right?
Not fully blow up, but yeah, obviously you take money out of your account and you can have a big drawdown and send the account to zero. I've done that a couple times and had to reload, right? So yeah, that's kind of what we mean by blow up. Some people actually lose it all, and those unfortunate souls can never come back into the game. But yeah, most traders I know have had a period where they've gone through some extreme drawdowns like that.
Yeah. Okay. Anything else you want to add? Any other advice for new traders?
Most
things.
I don't know. How about one thing? When you find that something's working, stick with it, and then stick with that strategy or stick with that stock or whatever it may be. If it's making you money, stick with it. And then if it stops working, adjust. This game is about adjustment, and markets are constantly changing. And if you don't adjust, you will eventually fail because the strategies you were using maybe last year won't work next year. And I've had to adjust majorly in my career many times. And the only reason I'm still here, unlike some of my former coworkers, is because I had the ability to adjust. And I take pride of that now, because after years and years, I've realized that's a big reason why I was able to stick this out.
Yeah. Okay, that's easier said than done, though.
It is, because our human nature is we like to be stubborn, and we like our ideas, and
especially if it's worked for a while.
Yeah, exactly. But you can't get married to those ideas. You got to forget about them sometimes and look for new ones.
Okay, this has been all good information. I think most people who listen to this podcast know I'm not a trader. I'm an investor.
Right, which is a totally different game. And, I consider myself a bad investor because I am a good trader. So I'll get out of stocks. I can pick stocks pretty good. I have a feel for stocks, right? But I will get out of them way too early. And that's just because my trader takes over my investor sense, and I get out too early. So, having Tesla at 32, that was great, but getting out at 300, not so great, right? Right.
Well, it goes both ways, because investors tend to get out, at bad times too, that a trader would not get out.
Right. Yes. As a trader, my risk is going to be like I'm gonna be stopped out on something. Investors normally they're gonna like double down on an idea, right?
Yeah.
So there's a totally different mentality to that, and you can't confuse the two. You have to be either a trader or an investor. So for like my IRA, I do not watch that every day. Otherwise, I'm not trying to trade that. I'm just trading my trading accounts, right? If I have a long-term idea, I'm like, yeah, I'll put that in my IRA, and I leave it. I let it sit.
Okay, that's smart. Yeah. All right. So let's go over the tickers. We mentioned a lot of them on this episode. So there was Tesla, of course. We all know that one, TSLA. We talked about Etsy, ETSY, Shopify, SHOP. Amazon was mentioned, AMZN. We also mentioned Netflix, NFLX. COUP Software, COUP, COUP. The WIMI ticker he talked about that had the crazy.
Oh, it was WIMI.
Yes.
Yeah, like WIMI or WIMI hologram cloud.
Okay. Yeah. Roku, is that just ROKU still?
Yep.
Okay. And then Spotify, SPOT. I think that covered most of the things. Did we mention Chipotle? That's another crazy one that's running.
Yep.
MG for that one. A lot of people trading that one. Okay, so that covers pretty much most of the tickers. They're all the hot stocks that everyone knows, so go check those out. And as always, you want to subscribe to the podcast here so you don't miss a single episode, because you don't know who's going to be on next week to talk about these interesting topics that are happening out there right now. A lot's going on in the market. So make sure you get all of our episodes. We are on SoundCloud, and most of you are over there subscribing. So thank you. And then we're also on Apple Podcasts, of course, and Spotify, the place to be for podcasts now. And we're on a whole bunch of other platforms. Just find us somewhere under Zach's Market Edge and subscribe. And I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.